Hello everyone, I'm Hadr Al-Hajri. I'll be presenting with Lauren and Ray, and we're talking about our bank performance in general. And specifically, we're talking about the second year investor presentation. And for the starter, I hope that everyone is safe and healthy.
So, firstly, we would like to give an overview of the conditions that the economy experienced over the last 4 quarters. In quarter five, the economic slump that we faced in quarter four was still prevailing. As a result, the Fed cut interest rates to stimulate the economy. In quarter six, the Basel Tier 1 and Tier 2 ratio minimum requirement dropped from 8% to 6%. Borrowing from the discount window also became less expensive as the premium decreased. Lastly, in quarter seven, we saw Basel risk weights on excess reserves decreased from zero point 0.2 to 0. Basel risk weights on mortgages increased from zero point 0.5 to 0.65, and the Fed also cut short-term rates due to the economic slump. Secondly, we would like to talk about our stock performance. This graph shows the price per share of our bank stock over the year and the changes from quarter to quarter. In quarter five, our price per share was $49.68. From quarter five to quarter six, there was a sharp increase in price per share to $81.81. This was the result of a share buyback in which we bought back 500 shares. The price then decreased to $62.57 in quarter seven, and then dropped even further to $51.28 by the end of quarter eight. We did issue a very small amount of dividends at the beginning of quarter eight, but unfortunately it did not boost our price per share as we had expected it would. Our stock prices did not perform as well as we had hoped after quarter six, but we did have higher prices on average this year than we had last year.
Next up is the Basel capital ratios. The Basel capital ratios are used to determine the financial strength of a bank based on its Tier 1 and Tier 2 capital and its risk-weighted assets. So there are 5 categories of capitalization under the Basel Agreement that are defined as well-capitalized, adequately capitalized, undercapitalized, significantly undercapitalized, and critically undercapitalized. In the fifth quarter, we started out as well-capitalized with a ratio of 7.56%, and in the sixth quarter of our capitalization rose to 9.10%, most likely due to the rise in equity caused by an increase in share price from $49.68 to $81.81. In the following quarter, the ratio fell to 6.44% as our share price fell back to $62. The ratio fell to a dismal 0.29% ratio, making our bank critically undercapitalized. This was likely due to the combined effects of the share price falling further to $51.28 and a sharp increase in the risk-weighted assets from 1.4 million to 2.6 million. The change in the risk-weighted assets were due to a large increase in the corporate floating rate loans. This essentially means that we are exposed to a large amount of risk that is passed on to our depositors, and mandatory actions will be taken by regulators to correct this capitalization error. We will be taking actions to improve our profitability, share price, and reducing the number of corporate floating rate loans in order to get these capital ratios back under control.
So as you can see that our net income had increased from quarter five to quarter six. And the decision that we had to take is reducing costs on retail demand deposit. That actually had helped the bank to increase the net income. But then from quarter six to quarter seven, we had a huge drop, and then even bigger from quarter seven to quarter eight. So the reasoning is that since the economy was bad, that the Fed had to cut rates, as well as us not taking the right decision and to adjust our costs. For example, in quarter seven, we took an action to reduce advertising costs for both retail and corporate deposit. Also, we repurchased shares, and that had us increase our costs. In quarter eight, we've had the biggest net loss in all of the quarters. The main reason is that our retail CDs were aggressively high. Our resources costing over 40,000. We've had an unexpected net loss in the second year that the economy slump caused, as well as our expenses.
So the next topic is loan performance. In quarter 5, the bank had a total of $425,000 in loans, primarily composed of fixed and floating rate corporate loans. Of these loans, 8.7 thousand, about 2%, were either non-performing or defaulted. In quarter 6, the amount of loans increased to $590,000, with the largest increase being consumer loans that increased roughly $86,000 in this quarter. The volume of non-performing or defaulted loans increased to about 9,000, 1.5%. The next quarter saw a decrease in total value of loans to $419,000, with several fixed-rate corporate loans maturing. The defaulted or non-performing loans were about 5.5 thousand, 1.3%, in the final quarter. Even more fixed-rate corporate loans matured, with an increase in corporate floating rates led to a total loan amount of $393,596.38, with $2.7 thousand the non-performing loans never got out of hand as we changed credit standards in Q6 to only accept high-quality loans. The lack of revenue can be contributed to the heavy reliance on floating rate loans combined with the economic recession. As the Fed lowered rates to combat the recession, bank income fell as well. To stabilize revenues in the future, the banks will need to reduce the reliance on floating rate loans and balance them with other types of loans.
Although we worked really hard to increase performance over the last year, we have decided to sell our bank to outside investors. Our bank experienced relatively poor performance during the second year. Upon review of the first year, we were expecting increased performance, but unfortunately, we struggled during the year. This was partly due to the slump that the economy was experiencing. We constantly struggled to manage high costs and absorb large losses during the last 4 quarters. Part of the failure can also be credited to the fact that our management team has limited experience, which certainly did not help our performance as the economy worsened.
And we could change the strategy to cutting down some cost and buying shares back and even paying out more dividends. But like, if we had to take this new strategy to help perform our bank more profitable, we could manage for the provision for loan losses better, and the economic slump was bad for us that we probably did not have a closer look at it, that we could take an action that could help it with the economic as well. So, and cutting cost, that would help for definitely, because on quarter 8 we've had a big drop in the net income, and that was because of the BTL CDs that were so high. So we could buy back shares, manage provision for loan losses better, watch economic closely, and cut down some costs. So, and thank you for listening.